Hello and good afternoon. We will now be presenting on our project for derivative securities and markets. My name is Amer Shadic.
My name is Dan Horton.
My name is Maxwell Clippy.
And my name is Jack Hoagland.
We begin by looking at question 2, which is a question analyzing different call option cases with some of the same variables held constant. So we begin with the constant variables being a 1-year call option with a stock price of $60. The stock has no dividends. The risk-free rate is at 4% and is continuously compounded. And as mentioned in this case, we will analyze unique option cases where these variables are held constant with slight unique changes in the option strike price and the standard deviation. And we did this by using the Black-Scholes-Merton model, and we were able to decipher these unique cases along with the help of the DervaGem software. And below was simply just the BSM model and how it works.
All right. So for question 2, we chose to do part A and part B. And part A had the uniqueness of having a standard deviation of 30% per year and a strike price of 0. Obviously, the outlier of those two variables is having a strike price of 0. So first, we tried to calculate DervaGem, which did not work. It did not calculate. And after thinking about it, it's kind of funny to have a strike price of 0. It's essentially thinking that the strike, like the stock, is going to be worthless. So the 0 strike price indicates an option of no value. This could essentially occur in governments where they would offer stocks that they think that are going to be worthless at maturity, and people could find profits off of those options if they exercise them at maturity. For part B, we looked at part C and D, and we realized that they all had a standard deviation of 0% per year, which can equate to 0% volatility. These B, C, and D had different strike prices, but the 0% volatility is what stood out to us. After calculating it in the DervaGem model, it did not calculate, and after using it in the BSM model, we realized that when you plug in 0% volatility, the denominator is 0, which would give it an indeterminable number. So essentially, after a little bit of research, we determined that 0 volatility has no sense of risk whatsoever. So you know that the stock price is not going to change over the maturity of the option. If a stock price doesn't change at all, then what's the point of having an option if the stock price will not change? There's no point. It is possible for the situation to happen if, say, a company is being liquidated. They know that the stock price will not change at all, and that would be like maybe the only scenario in which this would occur.
Next, we'll be looking at question 3, which analyzes different option strategies. So in this case, we see an investor, John, wanting to engage in a unique strategy where the investor buys the asset, then buys an out-of-the-money call option on the asset, where the two of these options have the same expiration. This is also known as a protective collar option strategy. As shown in the image below, it shows the payoff structure of this type of option. Now, in our specific case, we have a European put with a strike price of $45 on a 6-month option, and a European call with a strike price of $75 as well on a 6-month option. The current stock price of the asset is $60 and does not pay dividends, and it has an annual variance on the stock returns are continuously compounded at 50%, and the assumed risk-free rate in this case is 7%.
All right, so the total cost of the strategy is dependent on 2 scenarios. The first one being, does the investor not own underlying shares? If he doesn't, this will make the cost of the strategy much more expensive. As shown here, it increases by $6,000, and that is offset by writing the call. And then as if the investor already owns the underlying at least 100 shares, you can see the strategy actually can be quite cheap with the writing of the option, the call option, offsetting it by $435, making it only $260. So the payoffs at maturity, so the max profit will be capped, and this will occur at a spot price of 75 or greater for a total profit $1,760. And max loss will be capped and occur at a spot price of 45 or less at 1,240. So best scenario for this strategy, like I said earlier, it would make most sense if the investor already owned 100 shares, at least 100 shares of the underlying, and would protect recent gains from downward pressure. The usual time horizon for a strategy like this is short to medium term. You don't normally see this strategy being implemented in a long-term portfolio. So ideal setup would be already owning at least 100 shares of underlying asset, writing the call option and using the income from writing the call option to purchase the long put option. So if you're using this as a hedging strategy, it's a very cheap setup and provides great downward protection. The only problem with this strategy is that if the stock, during times of high volatility, if the stock does go upwards in your favor, you do limit that upside potential, reducing your profits.
My apologies, the presentation software was acting slightly unusual there, but now we'll be looking at question 4, and we'll be analyzing different Microsoft quotes. So in our final analysis, we will be looking at these quotes, and we attempted to select options with very close expiry dates to the current point in time, ideally within a week or so, as well as selecting options with exercise prices very close to the current stock price of Microsoft at the time. We'll be analyzing the cost of different straddles using these conditions above, as well as straddles on options with later expiration dates. We'll be also looking at the break-even point of these straddles and the percentage change in stock price to achieve these said break-even points. And finally, we shall explore a scenario where we take a long position on a straddle with a close expiration, while we go short on a straddle with a later expiration. Then we'll analyze when this scenario was plausible and what possible outcomes are. And these images below show the payoff structures of both short and long straddles, when and where break-even points would be, as well as the maximum profit points and the maximum loss points for the two of these options strategies.
So in creating our straddle position, we need to get both a call and a put option at the same strike price. Now, Microsoft's closing price at the end of 11/13 was $216.51. The options that were trading most near that were trading at the price of $217.50. So a 5-day call option at this point was $2.37, with a 5-day put option being $3.80. This brings our total straddle position cost to $6.17. Now, if we want to find the break-even points of the straddle position, we need to find the future value of this $6.17 at the time that we're actually going to exercise it. So that would be after 5 days. To do this, we just take the $6.17 and find out its value after those 5 days. And to do this, we use the risk-free rate of 7%, which was utilized in question 3. Now, this would bring this number up to $6.18. And so because of this, the two break-even points would either be $6.18 above 17.5 or below. This would bring us out to $223.68 or $211.32 being the break-even points. And these would be accompanied by an increase or a decrease of 2.84%. Now, when using that same strike price, if you look at a 1-month call and put option, the price at that point of the call is $4.75 and the put is $6.23. This makes our total straddle price cost $10.98, which at the end of 1 month will amount to $11.04 using that same risk-free rate. Now the break-even points would then be $11.04 above or below the 217.5, which brings us out to 228.54 and 206.46. This is an increase or decrease of 5.07%, which is greater than in the previous question because there's been more time for the stock to vary in price. Now, working with this info, something we can do is we can long the 5-day position and then we can short the month long, right? So what that'll give us is essentially a payoff structure where we will acquire a gain if the price has varied more after the 5 days than we would have expected, but varied less after the month than we would have expected. So what that actually means is that let's say that the price increases, right? If it exceeds the $223.68 after the 5 days, right, but still falls short of the $2 or the $228.54, then we'll have made a gain. If the price decreases and it falls below $211.20, but it still stays above $206.46, then again we'll have made a gain. So when would we utilize this? We would utilize this essentially when we think that there's going to be a definite change, right? But that the change isn't going to be so significant as to move beyond what would be predicted by the month-long options, right? So this could be, let's say earnings are about to be announced from Microsoft, right? And we know that there's going to be some form of significant price change. We know it's going to be so significant that it will, exceed the margin of change outlined by the 5-day option, but we don't think that it'll go beyond the values that are presented by the month-long option, right? So in that case, we're making a pretty safe bet by longing the 5-day and shorting the month-long position.
Thank you for listening to our project presentation, and we hoped you found our analysis insightful and very analytical, and we appreciate your time. Thank you very much.